we self-manage, and I've got team members, but it doesn't mean that I'm hands-free. Now, I'm not hands-free on my out-of-state stuff, but it's more, delegation. It's more leadership. It's leadership. That's what it is on my out-of-state stuff. It's not me actually going there and doing the maintenance or doing any of that type of stuff. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, real quick before we get started, first of all, I wanted to thank everybody for joining us on the show and for listening. To all my loyal listeners, I really appreciate you, continuing to listen and support the show. If you can go on to iTunes, Stitcher, SoundCloud, wherever you listen, and subscribe to the show, that would be fantastic. Spread the word too. I'd love to, have this reach more and more people. So if you could share it on social media or and just talk about it to other people, that would be fantastic. And the last thing is, if you can go onto iTunes and give us a rating review, hopefully 5 stars, that would be great as well. It just helps us spread the word more, and it helps us continue to get really good guests on the show. We've had some fantastic guests, and I just want to be able to continue to bring fantastic value to you. Go onto our Facebook page too, Pillars of Wealth Facebook page, and I'd like to hear from you as a listener of what you're doing in business, what you've got going on, what you are maybe struggling with or being successful with, and then what we can do on the show to help push you to that next level. Maybe questions we can ask our guests, maybe guests that we can get on the show to talk about certain topics, certain things that are really you're needing some extra support with. So provide for us some feedback on Facebook, and you can also share this out on social media. That would be fantastic as well. I appreciate it. I appreciate you being a either new listener or a loyal listener. I definitely appreciate it, and we will get started with the show.
All right, welcome back everybody to another edition of Hump Day Hustle, the show where we focus on business and real estate as our core pillars of wealth creation. My name is John Stiles with Bridge Realty, and I'm excited for another great episode. Today, we're going to be talking about out-of-state investing versus in-state investing. So with that, here is our host, Todd Dexheimer. Todd, how are you doing today?
I am doing well, John. How are you?
I'm doing great. Are you, is your household changing much with the kids now home from school, or?
Yeah. So we have a nanny in the summer, and my office is right off of the main living room, kitchen. I mean, you could probably, if those who are watching could probably see my kitchen actually directly behind me. So I am in my office most of the day, and it can get a little loud and crazy with my kids at home. So at times, right outside of my office, there's a little patio with a little table. At times I go out there and get a little peace and quiet so I can not only enjoy some nice weather, but also have some concentration going on. So, it's good though. The kids have fun, and they're running around. They're in all kinds of sports and stuff. So they're only at home part of the day anyway. So,
yeah.
Yes, sir. Yeah. So I wanted to talk about our topic today, out-of-state versus in-state. I recently was speaking at a meetup. I spoke at a meetup on Tuesday, and there was a gentleman there who, through, I think, good intention, he wanted to learn a lot himself, but was kind of a heckler. I shouldn't call him a heckler, because he was asking very good questions, but it was more of questions that maybe we could have done one-on-one, but some of his questions were about out-of-state and why out-of-state. Why would you do that? Why wouldn't you be in-state? Because he's got friends that invest, and some of them swear by in-state investing, and he's very, very good questions of, well, why? I don't get why you would do that. And he asked some other very interesting questions as well. I thought were really good, that we probably won't get into right now, but further on down the line, he was asking questions, really about syndication and why syndication versus investing in like a triple net lease or investing in a REIT. And I think maybe we've kind of hit on that before, but it'd probably be good to even hit on that again as well. So really good questions that he was asking. Like I said, it was kind of maybe sometimes not in place, but hey, that's all right. It made it interesting. It made the meetup very interesting. Added some, he shook it up a little bit. So if he's listening, good job shaking it up. And we're going to hit on that topic. So if the gentleman is listening, hopefully he can learn a little bit more about why out of state versus in state.
Yeah. Well, I wasn't there to see this, but I know that, it's good sometimes when one person has the question, a lot of other people might have the question too. So,
well, the topic was about syndication.
Okay.
Right. So it got off topic a little bit, but that's okay. I mean, he had some questions he wanted to answer, and I was hopefully able to provide some good answers to it. So let's kind of dig into that, John. You invest primarily in state. What makes you decide to invest in state versus why didn't you go somewhere else?
Yeah. Well, for me, I started with what I knew, which was, our local market. And probably, when I started, I was using a common strategy that people call house hacking. So I moved into one of the rental units in the building, and that worked out as a place to help out, me have a place to live and be able to invest at the same time. So that's kind of the initial reasoning. And yeah, I think just other reasons is it allows me to be more involved, which is something I like to do. Be involved in viewing the property frequently, and taking care of maintenance. If I know that that's not the right situation for everybody, but for me, it's pretty easy to just run over the property and take care of small things. And so for me, I like being involved in that.
Okay. Cool. And I think that's, most people invest very similar reasons in state is because it's convenient, right? I mean, if you're living in the Twin Cities, Minnesota, and you're going to buy some properties, it's very convenient to go into Minneapolis or to St. Paul or into any of the suburbs and buy some properties and keep them as rentals, right? That you can get there if there's maintenance, you can do showings, you can talk to your tenants, you can go over to the property, drive by it, all those kind of things. So it's really easy. You can tangibly see it. So I think the biggest reason is the convenience, is quite simply that most people. And when I look back at why I invested so often in the Twin Cities and did not venture really outside of our area for quite some time, that was why. It was just convenience. I looked at other markets through my computer. I didn't really go to other markets early on, but I looked at investing in, Phoenix, Arizona, and other markets that really got smacked hard by the recession, and looked at investing there. And when early on, before I have actually transitioned to apartments, I looked at investing in apartments in other areas. I wanted to invest in Dallas, Texas. I wanted to invest in Phoenix, Arizona. I wanted to invest in the Carolinas. And that was back in like 2011, 2012, but I never ended up doing that. And because my backyard was so convenient. So I think that's probably the biggest, truest answer is your backyard is convenient. And that's probably maybe the biggest reason to invest is you can remain in control. You can potentially cut costs because you can, even if you're not doing the maintenance yourself and not doing the showings yourself, you can potentially build the team in-house as you grow and scale. And that allows you to then, you know, be able to control your costs, be able to control the property, what happens. Again, you can have people drive by, you can drive by. It's very easy. It's right there. So those are all definitely benefits, or can be benefits. They can also be burdens as well. So those can be definitely benefits. And here's, I think probably this is true yet false. So we know our own backyard, right? We know the market, and we don't know our own backyard. And why this is very false, though, a lot of times, is we think we know our market. When I was first starting to invest, I remember thinking I knew that North Minneapolis was a bad place because it's dangerous and there's a lot of crime that happens there, and East St. Paul. And that is maybe true. There is heightened crime in certain areas of East St. Paul and North Minneapolis. However, the whole area is not like that. And so there are great pockets to invest in. And just being local, most people would tell you to stay away. My wife and I, our very first house that we purchased to live in the Twin Cities was in an area where, when we put an offer on the house and got it accepted, and she was telling her coworkers, they all said, "Holy cow, get out of, don't buy that house, stay out of that area. It's a terrible area." Well, we ended up not listening to them. Very happy we didn't, because it was an amazing area, and property values really skyrocketed in that area. But that area was bad back in the 1980s, and that's what they remembered as. So a lot of times we think we know our local markets, yet we don't. One of the benefits of out-of-state investing that I have had is I've understood now how to research markets. And I understand that by investing locally, I had no clue what I was doing. I just was buying properties because they cash flowed, and because they were cheap, and because, I knew I could make money on them, or thought I could. But I had no clue where the areas that had the most growth were, and any of that kind of stuff. I didn't know why the fundamentals were good. I just thought I had things figured out, where in reality, I probably got more lucky than I got skilled. And I think a lot of local investors, and even seasoned local investors, it's very similar. They have no clue about the metrics of their market. They don't pay attention. They don't know what cities have the highest employment growth, and where the jobs are truly going, and what kind of industries are going on there, what the demographics are. They don't know a lot of that type of stuff. They're not paying attention to a lot of the city, ordinances and city planning that's going on. They're not doing that type of studying into the market, but they're still buying. And an out-of-state investor, that's what you do. You really hone into the statistics and pay attention to really what's going on in the market, and study it, and know when to enter, know when to exit, or at least try to time that the best you possibly can. So I've ranted for a while, John. Why don't you come up with some thoughts of what I just said?
Well, I'll concur that, something bad might happen in one particular house or one particular block, and then the whole neighborhood can get a bad reputation for that. And plus, those bad areas, they move around. It's not stagnant. It doesn't just stay in one spot and never change. So you do have to, stay informed and have an open mind. And maybe if you are going to stay local, get out and try new restaurants that are in neighborhoods that you wouldn't normally go to, or that you don't always go to, or kind of, get around so that you can learn about the ever-changing environment that we're in, because it is constantly changing. new buildings are going up and neighborhoods are changing. So
Yeah, it definitely, and I think we locally just, the thing with the local investor versus an out-of-state investor is there's advantages and disadvantages, but the local investors, I think a lot of them get lazy and they don't really, they just go by what they quote unquote know, whether that what they know is true or not. And so I think that's the biggest downfall with in-state investors. With the out-of-state investors, obviously the biggest downfall is they're not there at the market. So you can research an area and say North Minneapolis is a high crime area, and they'll go, okay, I'm going to stay out of North Minneapolis. I don't want to be there. But then they might miss some golden opportunities where the in-state person does potentially know through experience that there are some great areas that they should be investing in, or maybe that there's some other type of legislation or something going on in that area that really is going to change that area, and they want to invest there locally where somebody from out of state maybe couldn't figure that out without that firsthand knowledge. So there are benefits to being local, but I think the local investor, the biggest thing is don't be lazy. Like, don't just think because you're in the market that you know your market, right? Study it, learn it, understand it. We were at a conference, we mentioned that just a couple weeks ago, where they're throwing out statistics on our market, and they weren't statistics, they were just what they thought. And just because they're familiar with the market, I think those numbers just come out of their mouth, where they might have been true at one time, but they're not true right now. So a lot of us get lazy sometimes, and I don't mean to call that broker lazy, because maybe they're not, but a lot of us get lazy sometimes, and we just think we know our market.
yeah.
Hey, I'm super excited to announce the North Star Real Estate Conference that I am putting together along with a few other friends, and we are expecting to have a great crowd there. This is going to be September 20th and 21st in Minneapolis, in the Twin Cities area. And hey, it'll still be warm, and we're going to have a ton of great speakers there. We're going to have some motivational speakers. We're expecting to have speakers talking about a lot of different commercial real estate topics, multifamily and commercial real estate. So we want you there. We would love to have a great crowd there. We would love to have you there. And the cool thing with this conference is all the profits are going to benefit charity. They're going to benefit Junior Achievement specifically, who they serve underserved youth, and they bring financial education to them. They not only teach financial education, but they teach the kids how to be entrepreneurs, how to be business leaders, and how to really do fantastic things after they're out of school and moving on. So that's who we're going to be benefiting. We're going to also have a charity gala. It's going to be a fun event, and I'd love to have you attend. So again, it's called the North Star Real Estate Conference. Check it out. We've got links that we'll put on the show notes. We would love to have you there. We'd love to have you attend. Speaker lineup is coming, and that'll be announced shortly. We do have a few speakers already lined up, so you'll be able to see that. We've got Trevor McGregor will be our keynote speaker. He's a master platinum coach. So you're going to love this event. We are going to just have a ton of fun and learn a bunch, and also benefit a great organization as well. I will see you there. Check out our show notes for the links.
Well, just looking at some more pros and cons of in-state versus out-of-state, wouldn't you say that the barrier to entry is maybe lower if you stay locally?
For the most part, yes, right? If you stay locally and you build those relationships, you're probably going to have a better chance of finding off-market deals. However, I think again, and all things equal, all things equal overall across the board, in-state investing is better, right? If your market is really good, if all the fundamentals are right, if you do your own homework, if you do a good job building relationships with brokers, if you're proactive, all things being equal, in-state investing is better. However, if we've got a market where the fundamentals are really good out of state and we can do a really good job communicating with brokers, oftentimes we're doing a better job as an out-of-state investor communicating with brokers than the in-state investors are, because the in-state investors just assume, because they're in state and they've talked to the broker and they've met them before, that they're going to get the deals. They're not staying on top of the brokers. And I find that quite a bit as I'm out of state, is that I feel like I've got a leg up on a lot of the in-state people because I am communicating with the brokers constantly. I am aggressive, and I'm wanting to, not necessarily aggressive in my underwriting, I'm aggressive in how I am approaching the brokers. I'm constantly staying on top of them. And so I think that's, again, about being lazy. In-state people oftentimes are lazy, just assuming they know it all and assuming they've got the relationships already nailed down.
Sure.
So,
well, let's take an example of like somebody who has a different business that they're operating and it's going well, and now they've got quite a bit of cash saved up because they have, they've done well in their business, and now they're getting kind of dissatisfied with their savings rates in their bank account. So maybe they've got, I don't know, $300,000, just for an example, or you could use whatever number. But so, just let's talk about how far could that go in our market versus a market like some of the ones that you're looking at.
if they've got 300,000, how much? 300?
Well, I don't pick a number. I don't know.
Well, I mean, $300,000 here, down payment, you're going to be able to buy at the most $1 million property, which is probably what, like a 6-unit, 8-unit, maybe up to 10-unit. It depends on where you're at, right? So between a 6 and a 12-unit, it's probably $1 million property. Again, it's going to depend on the market that you're in, but you could buy, you're going to buy the same amount, right? You're going to buy $1 million property either way, but that $1 million property in some of the other markets that I'm in is going to be a bit double the size, roughly. So anywhere between about 12 and 25, even 30-unit building.
Mm-hmm.
Maybe even more if you're buying something distressed, but again, in Minnesota, you could buy something distressed there too. However, we don't have a lot of distressed properties here.
Yeah.
So yeah, so here, $1 million, 6 to 12 units. Other places, you can buy 12 to 30 units probably.
Yeah, and of course, the rental numbers will be different and the cash flow will be different, but
right.
Yeah.
I mean, you gotta compare the whole thing, right? What's happening here in Minneapolis? What are we seeing? We've got low vacancy rates. We've got some good fundamentals, but we do have slow population growth. And a lot of people think we've got this great population growth, but we've got less than 1% per year population growth. Not that that's terrible. We've got higher than 0.5%. So as long as we're seeing close to that 1%, that's pretty healthy, but it's not like it's explosive at all. We've got higher occupancy rate, but we also have the highest amount of building that we're ever seeing too. So we've got some potential danger there. However, we're seeing very little single family houses being built. So that does help prop our multifamily up. So, I mean, there's good things in the Twin Cities. I'm not saying that you wouldn't want to invest here if you're local here, but you just got to be aware of all the potential ups and downs that are in this market. And then you got to look at other markets. I mean, you don't want to just invest in a market. I'll pick on Cleveland, Ohio, because I don't really pay attention to Cleveland, Ohio, although I did slightly look in that market. But you go in and you can invest in a Cleveland, Ohio, and get a 12 unit here for the same price as you get a 35 unit in Cleveland, Ohio. And you go, wow, I can get a 35 unit there for the same amount of money. But, the population in Cleveland is declining. The jobs, are they coming in? I don't know that statistic offhand, but, what type of jobs are coming in, all that kind of stuff, there might be a big difference. So we don't want to just pick a market because it's cheap and it's out of state. We want to pick a market that's got the fundamentals that we really are looking for, which is that job growth, the population growth, got good rent affordability. It's got good things happening. The city's got good things going on, good comprehensive plan. It's landlord friendly. Those are really, really all really important things that we want to be looking for when we're looking into market. And is there opportunity? Is there any inventory? That's a big thing with Minneapolis. There's no inventory here. There's very little opportunity to buy anything that the numbers even make sense. I mean, I'm looking at 115 unit, or was looking at 115 unit, and I'm off on that mark by about 35%, what they think it's going to sell for. So, I mean, that's not opportunity in my opinion. So those are reasons to go out of state. I can think of investors were buying properties in Minneapolis in the 1960s, 70s, 80s, and even 90s. Well, Minneapolis was a declining city in the 1960s, 70s, 80s, and 90s. But they were still buying properties there because they're local people, right? And their local people are buying these properties, and there's terrible fundamentals going on. And a lot of people probably lost money because the city was declining in population. Now, our age, most of us don't really realize that and think about it that way, because the city of Minneapolis has been gaining population ever since we've really been adults, ever since the early part of 2000s. Minneapolis has been slowly gaining population. The Twin Cities in general has always been, or not always, but mostly been gaining population, maybe even always been gaining population. But Minneapolis and St. Paul themselves had lost a lot of population during those decades. And again, local investors were still investing there because it's local and it's comfortable for them. And they think that's the best opportunity, where really, if they would have invested in let's call it a Phoenix, Arizona, or a Dallas, Texas, or whatever, you can name a bunch of markets, they would have been way better off.
Yep. Well, and today with the technology we have, it's easier to go to other markets. You can get the data a lot easier. You can go visit the properties a lot easier, and just stay in communication with your management team. So
one of the things that I always, when somebody says, well, out of state investing, isn't that risky? I say, well, okay, sure. There is some different risks to it involved, but there, in my opinion, there's also risks to be an in-state too. Like I've already said, you get lazy, you get sloppy. Sometimes you don't pay attention to the statistics. If I had never gone and started investing out of state, I don't think I would be as aware of an investor as I am right now. I also have learned how to delegate better. I've learned how to count on other people and learned how to hire property management companies. And a lot of that is learning through making mistakes. But, I think I've become a better business owner overall because of it. But let's ask a couple questions. I mean, Sam Zell, right? He's got $5 billion net worth, and he's a real estate investor. He's the owner of one of the larger REITs in the U.S. Where are his properties? Well, they're all over the U.S. Okay. Does Sam Zell go to his properties every single day? I doubt it. How about Walmart? Walmart's based in Arkansas. Have you seen a Walmart in your market ever, John?
Yes.
Okay, so they don't invest only in their backyard, apparently.
Right.
So, how about Starbucks? Have you ever seen a Starbucks around here?
Yes.
Where's Starbucks based out of?
I don't know.
Seattle. Okay. Sorry to put you on the spot. But my point is, companies, any company that that's a national company, which there's a lot of them. They don't just invest in their own backyard, right? They're everywhere. McDonald's, I don't think they're only in. I don't even know where they're based out of right now, but I believe the first McDonald's were out of California. I don't think that's the only place they're in right now. I'm pretty sure I saw one today. So, it goes to tell you that when people question about investing out of state, well, there's, in my opinion, some very clear reasons to do it. Always investing in your backyard doesn't necessarily give you the best opportunities. So this gentleman's questions, a lot of them were very valid. Again, can't you, what's your competitive advantage? People that are in state, don't they have a better advantage of finding contractors, for instance? Well, sure, maybe. But I can build relationships just like they can, right? I mean, I've got local people that I hire, and they can build relationships and stay in contact with the contractors just like they can. I can still go through a competitive bidding process just like they can. You can't find properties just like these in-state investors. Well, sure, maybe not, but I'm not as lazy as them. So I do find more properties, and some of them are better at it than me, right? But the multifamily investing world, and any industry that you're in, quite frankly, it's very small overall when you look at it. There's not that many buyers. And now we're in a very competitive market. So people might say, you're crazy, there's tons of buyers. But honestly, the real field of multifamily investors is still a pretty small world overall. And so there's just not that many buyers, and they can't buy every single property.
Yeah.
So yeah, there's advantages, disadvantages, but in my opinion, there's the advantages don't outweigh the advantages of investing in state don't outweigh the advantages of investing out of state. I think you have to look at the whole market, the whole situation, decide which one's right for you. One of the biggest things probably that's a deterrent to multifamily investing out of state, or anywhere, any type of investing out of state, is, can you travel? It takes up time. I'm going to be gone Monday through Wednesday next week. I'm going to be away from my family for 3 days. I'm going to be away from my office for 3 days. I've got to change my schedule to make sure it evolves around my trip. Can I do that? That's probably the biggest disadvantage of out-of-state investing overall.
Yeah. So I think just another thing to point out is that out-of-state investing kind of forces you to really set yourself up as an actual business.
Absolutely.
Where you're like running the business instead of, operating in the business. When you're local, you can have that option to work in the business. And some people, that's the right thing for them. But just realizing that they're not going to be able to scale that to a very large amount. And then it's not always the best thing for, what's going to happen if they suddenly are disabled or pass away or what, it kind of can become a disaster if they don't have lots of systems and processes put in place.
Look, how many property showings have I done? How many Craigslist or any kind of apartment ads have I done? How much tenant communication have I had with my out-of-state properties? 0 minutes. Okay. With my in-state properties, still to this day, I am involved in that stuff. I'm not always involved in that stuff, but I do still to this day do some showings here and there. I still to this day throw in some rental ads. I still to this day talk to some tenants. So we self-manage, and I've got team members, but it doesn't mean that I'm hands-free. Now, I'm not hands-free on my out-of-state stuff, but it's more delegation. It's more leadership. It's leadership. That's what it is on my out-of-state stuff. It's not me actually going there and doing the maintenance or doing any of that type of stuff. So it's just different. You, like you said, you have to treat it like a business if you're going to invest out of state. If you don't, you're not going to have success. So you have to be a leader. You have to treat it like a business. Where in state, you can treat it like a hobby and you can still do just fine.
Yep. Well, I think that's where I was getting to with the barrier to entry question earlier. Some people started as a hobby and hopefully it can eventually turn into a business and really truly a passive income.
Yeah.
But I think a lot of people start thinking that it's going to be passive, but then not realizing how much work is really involved.
Yep. Yeah, when they're in state, you mean?
Right.
Yeah, for sure. Absolutely. So anyways, I just wanted to cover that. I don't know that there's much more we need to cover other than if somebody's thinking about investing and wondering whether they should invest in their own backyard or somewhere else, they should really break down their market and decide if the fundamentals are right for them. And if they decide that the fundamentals aren't right for them and they have the time freedom to be able to travel, and it's not a ton of traveling, by the way, you're probably traveling 4 to 8 times a year, depending on how involved you want to be and how aggressive you're trying to be. So do you have that time freedom to travel 4 to 8 times a year for let's say a 3-day period at a time? If the answer is yes, and your state, your city, more than anything, your city isn't very lucrative to real estate investing, you may want to think about out-of-state investing.
Yep. However, if you're in the Twin Cities and you do want to stay local, then call me.
Call John Stiles with Bridge Realty. Yeah. No, and there's good stuff going on in the Twin Cities. I'm not saying it's a bad market. It's just, it's very difficult to find properties that pencil out for what I'm looking for. Now, I don't look for properties that are 5 to 20, 30 units. I'm looking for properties that are 100 plus units. So I don't know what the property competition is like in that, let's call it, well, even a duplex all the way up to a 50 unit. I really don't know where the competition level is, and if you can find anything that's a value add, I'm not sure. Call John Stiles to figure that out.
Yeah, we'll talk about more details one-on-one, but it is competitive, but there's deals to be had if you're just willing to stay at it. So
yeah, and everybody's deal is different, right? Everybody's idea of a deal is different. So
right.
I have that conversation quite a bit. There's a lot of people that their idea of a deal is not a deal for me. And I'm sure there's plenty of people that the deal that I'm looking at would not be a deal for them. So everybody's deal analysis is a little bit different. Cool, John. Well, that's all I got.
Very good. Well, our listeners and viewers, we really appreciate you tuning in. We'd love it if you would join in the conversation. You can comment on the YouTube video. You can comment on our Facebook page. And I'd love to get your interaction on this. And while you're at it, go ahead and give us a rating and review on iTunes. We appreciate that.
Awesome, man. Thanks. Appreciate it. And hey, make every day a Saturday.
You too.
Hey, thanks for listening to the show. Couple things before we go. Again, go on to our Facebook page, Pillars of Wealth. We'd love to have you on there. Go on to iTunes, give us a rating and review, and subscribe to the show. Also, don't forget, reach out to me if you want any help with potentially growing your business, and reach out to John Stiles to help you buy or sell real estate. Thanks for listening. We appreciate it. Have a fantastic the rest of the day. And as I say, make every day a Saturday.